Hey everybody, it's Chris with Life 180. In today's video, I want to talk to you about the 5 biggest mistakes that people make when they look at getting an infinite banking policy. So if you look around, you'll notice I'm not in my studio. I'm actually in a hotel room. I'm in Dallas right now. I'm speaking at an event over the next couple days, and I just wanted to be able to create some content while I had some downtime in my room. So I've got my GoPro out, and we're going to film it like this, and we're going to see how it goes. So let's get into this. Mistake number 1 is I find that people spend way too much time focused on the illustration and the interest rates inside of the policy. Now, don't mistake what I'm saying here. I know I spend a lot of time talking about the importance of structure, importance of design of a whole life policy. All that holds true. But what happens is if you spend so much time comparing the internal return and performance of a whole life policy, and you compare it to other assets, other investments, whole life insurance is always going to come up short. There's no doubt about it because you can't compare it to those other things. And that leads me into mistake number 2. Mistake number 2 is you think of your and asset, your infinite banking policy. I like to call it the and asset. You think of it as an investment, right? Here's what I want to stress. Your banking policy, your and asset, your properly structured whole life insurance policy is not an investment. It is not an investment. You have to stop thinking of it as an investment, because think about it like this. What do investments have that make them investments? They have high upside, but they also have a lot of risk. When you properly structure a whole life policy, we call it a banking policy for one reason, because it's an alternative strategy for a bank account. You get to play the role of banker in your own life. We like to call it the and asset because you can take it and do so much more with it. You can save your money inside of a whole life policy, right? And you can have the opportunity to access that money and invest it in other areas, whether it's real estate or your business or crypto or trading or anything that you deem appropriate for your risk tolerance. You can take that. That's why we call it the and asset. A lot of people say, why would I want to put my money in a whole life policy, right? If that performance in that policy is going to be so bad when I can put my money over there. That's an either or conversation that's going on in your mind. That's why we call it the and asset, because whole life insurance is the only place that you can put your money that's going to get you a guaranteed rate of return as a banking alternative. It's like a bank account on steroids. It's going to give you liquidity, use, and control of your money, give you access to that money. That way you can have the policy of the whole life insurance that'll get you all the protection you need, all the guarantees you need. And when you find the opportunities in the investments that work for you, then you can access your money and do both without interrupting the compounding of the money inside of your policy. The third mistake that I find that people make are people depending way too much on their financial advisor, right? See, either you follow an advisor who tells you it's not a good strategy because they don't really even understand what they're advising you out of, because quite frankly, most life insurance agents don't understand how to do this properly. So how do you think a broker is going to be, a stock broker or a typical financial advisor who does fee-based investing? They're not going to understand how to do this. What they think you're doing is not what I'm talking about right here. So relying on them is not a good strategy, right? Like when it comes to you making a decision for your financial well-being. But on the flip side of that, I'll also say this. You have to take accountability, full accountability for the results in your life. And so when I talk about this being an and asset, that has to do with you becoming the person that you need to be for this to succeed. Not relying, not just setting it and forgetting it with an advisor and letting it go and not having to think about it and just hoping that they're going to do their job and get you where you want to be. The reality is, for you to get where you want to be, you need to do your job. You need to grow into that person. You need to learn about those things. We call this the and asset because you need to find the opportunities outside of the policy, right, for you to be able to leverage and optimize your financial strategy, the financial system in your life. How do you want to use this policy for you, right? Like a lot of people use it for businesses. A lot of people use it for the way that they pay off their home. A lot of people use it for the way they finance their cars. A lot of people use it for many, many other things, how they fund college for their kids. But the bottom line is, the one thing I know, it will increase the financial efficiency in your life. And what I know to be true is making sure that you focus on efficiency before going out and chasing returns and taking on risk is the only way to guarantee that you're going to get to where you want to go on a more predictable basis faster. And it's going to force you to become more and be more in order to achieve it. And what more could you ask for from that? To me, it's a win-win-win situation all the way around. So mistake number 4 is that people take loans and don't pay them back. Now, it's really important to understand this. If we're creating a banking system for yourself, you would never take a loan from a bank and not pay the bank back. That's just a fact, right? You always want to make sure that if you borrow against your policy, it's great because you're never interrupting the capital in that policy. But it's also important to understand that when you take a loan against that policy, there's a lien on that money, right? Now, that lien can go on for a long time, and it's not a big deal. And if you pass away, they'll take that lien out of your death benefit, and that'll be fine. However, if you're looking to truly grow your wealth and really maximize and optimize the system, you want to make sure that you don't steal from the golden goose. And the golden goose, right, is the actual policy, right? So if you're taking loans against the policy and you're not paying them back, you're basically stealing from the golden goose and you're killing the golden goose slowly. So you want to make sure that any loans that you take from the policy or against the policy, I should say, you make sure that you pay those back. Otherwise, you're never going to be able to maximize the system that you're operating in. And finally, mistake number 5, and this is probably the most common and most misunderstood mistake that I find people make, is that they want to try to stop paying into the policy as quickly as possible. People come up to me all the time and they go, well, could I pay in this for 5 years and then be done? Or 10 years, 7 years, 15 years, 20 years, and be done. I don't want to pay any longer than I have to. I'm going to tell you right now, if you are thinking that way, you are thinking about this all backwards. What I want to tell you is that you want to try to be able to put as much money into this policy for as long as possible, right? As long as you have income that you're generating and earning, and as long as you're in the accumulation or saving stage of life, you want to make sure you are putting as much money into this for as long as you can. Because here's the deal. Yes, there's a cost to doing an infinite banking policy, to creating your own end asset, to doing a properly structured whole life insurance policy. There absolutely is a cost. The front end of this, the fees are very front loaded, right? Once you get to 10 years, where a lot of people I hear is either 10 or 20 years, it kind of seems to be the mark that people have in their mind when they want to stop paying. Once you get past the 10-year mark, you're not going to find a more financially efficient and effective vehicle. Every dollar you put into this policy, you're going to be able to get probably a 4% internal rate of return on every dollar from there moving forward without giving up liquidity, use, and control of that money. Find me another vehicle right now that will give you 4% guaranteed, completely liquid, right? It doesn't exist. And if interest rates go up in the economic environment, the federal funds rate, all that goes up in the future, dividends will improve in whole life policies and rates will go up, right? So you participate on both sides. If they go down or if they stay, they can't really go down. If they stay in this long-term, low interest rate environment, then you're going to be in a situation where you're going to be guaranteed whatever the guarantee. At this point in time, there's still companies when I'm filming this that you can get 4% on. I know some companies are going to be dropping that to between 2 and 3 3/4, depending on the company. That's going to shift the industry up a little bit. But once again, what's really, really important is that when you get into this policy, you're going to want to keep it going once you realize how just amazingly efficient it is to help you build a flexible financial system that will help you achieve exactly what you want to achieve. I know this, I've worked with a lot of real estate investors, I've worked with a lot of entrepreneurs who, when they get these policies in place after 7, 8, 9 years, they are absolutely solid gold when it comes to the most powerful asset that you will ever have in your life. Yeah, there's a little bit of a time at the beginning where you can still leverage them. They're still amazing, but for the first 2, 3 years, there's a cost to it. There's no doubt about it. So you have to think long-term. You have to think for the future. You can't just think about this year, next year, the year after. You always have to be thinking long-term because let's face it, probably the goals and the objectives that you have are longer term, right? I mean, whether it's your business, depending on what stage in life you are, I know most of the people that I talk to have probably a 20 plus year time horizon in which they're looking to plan for their future. Now, if you don't have that long, it's still okay. It can still work really well for you. But I'm just speaking to most of the people that I know. If you have a 20 plus year time horizon, then you have to think, how am I going to achieve my objectives long term? The beautiful part is if you design a policy properly, you can get the benefit of having short-term liquidity use and control. But my point is, on this point of people wanting to stop paying into the policy after year 10 because they think of it as a premium instead of a forced savings account, that's the biggest problem. So anyway, those are the 5 things. I hope it helps. I hope it makes sense. If you have any questions about anything, go ahead and make a comment in the conversation below, and I will be sure to engage. But anyway, I hope you have a blessed, inspirational day. I will be talking to you about what I'm here in Dallas for soon and what's going on there. Be on the lookout. Make sure you hit that subscribe button, hit the bell. That way you get notified when I talk about it. Hit that like button if you found value in this, and I look forward to talking to you soon. Take care.